So, hello and welcome to this week's instalment of Nucleus Investment Insights, and we've called this one today Changing Tack, and all this, the reasons for this will become very apparent throughout our thing, but let's just say it's on the basis of some new data points that have come out over the last few weeks, and we've had a terrific run of special guests, so we thought now would be a good time to check in and give our investors and future investors an opportunity to see what's been happening in the background whilst we've been running through our recent spate of special guests. So with no further ado, let's jump into our agenda. So we're going to be looking at the China debt explosion, relevant currency effects on that as well, therefore the follow-on effects on Australia, a longer-term outlook, and then as always the implications for investment on how we run money every day here at Nucleus Wealth and the MB Fund. I'll welcome our Head of Investments, Damien Klassen. G'day, Damien.
Hi, Tim.
And our Chief Strategist, David Llewellyn Smith. G'day, David.
G'day, Tim.
Plenty of oomph in that one. I think I'm really looking forward to today's one, actually, because I've just come off a week's holiday, so it'll be great to see what you guys have got for us. We'll roll into our first slide of the day, being the China debt explosion. Who would like to begin?
I'll take this one. So readers or listeners will probably be aware that we've been very focused on China. Well, we always are, but especially so in the last kind of 6 to 12 months, as it went through a large deleveraging episode. Well, not really deleveraging, but disleveraging, as we like to call it, slowing debt growth. The change being in the second derivative, not the first. This first chart that you'll see here is Chinese broad credit, which is total social financing plus bonds. And you can see we've just been through a little mountain, which began in 2016 and then peaked in 2017, has been diminishing ever since. And so we've been anticipating slowing Chinese growth, which we've seen. And, over the last 12 months, we've been tracking this incremental stimulus that's been coming out of China as growth has been inexorably following this little credit mountain downhill.
And I guess two things to add to that chart. One is it's worth noting that this is a growth rate, so the actual amount of debt in China has been growing quite significantly, and so even though those little hills are getting lower and lower, the actual dollar amount coming out has been increasing.
Yep.
And the second part is that if you sort of roughly compare those numbers with something like a GDP number, you can see that they tend to be well above GDP, and so the actual numbers that are, the amount of debt that's required to generate each dollar of GDP, especially as we think the actual GDP is a fair bit lower than what's reported, is still, certainly significant in terms of the whole scheme of things.
That's exactly right. And you can see just in the last 3 months that there's this little hook that's appeared on the end of the chart, where total broad credit has suddenly bottomed and is starting to rise at very similar sort of trends as we've seen when these other little mountains have appeared. Now, as I said, we were tracking incremental stimulus in China over the last year, and typically that doesn't get any traction. They always give it a go, but it never seems to do much. And then in January we saw a huge credit surge as in particular China sort of started to really suffer from the trade war with Donald Trump and the US, and then a pullback in February, and now we've just had March figures in the last week, and they really are tearing the roof off again. So obviously at this point it's only a little hook on this chart, but this is a year-on-year chart, and I probably should have put in a month-on-month, and if you do that, you find that month-on-month, year-on-year, credit's up 50%.
Wow.
Already. Yep. And, excuse me, with 3 months into it, it looks like the credit spigot is wide open again in China, and it's a real drenching.
And it's also worth noting that the January, February is quite hard to tell usually, because there is a change in when Chinese New Year comes in. And you do get a lot of sort of funny things going on in terms of data that comes out for that first couple of months of the year. And so we sort of looked at the first 2 months and it was a bit hard to tell whether there's things affecting it, or certainly the first month, certain things affecting it. The February wasn't as big as January. January was sort of huge, which sort of led us to question, well, maybe they might be pulling back, and that was just a one-off seasonal effect. But it's pretty clear from the March data that's not the case, and that it is a genuine push.
Yeah, it was the largest March of new issuance ever.
Wow. Yep.
I mean, March always bounces. It's a seasonally strong month, but this was way ahead. So it does look like they've hit the accelerator again. And if you want to pop through to the next chart, you can see the same hook appearing already in household debt, which has been a recent quite strong driver of debt growth and GDP in China over the last little mountain. Again, this one is year on year, so it doesn't show it up very well, but there was a big surge in household new borrowing in March, and that's basically mortgages.
Yep.
So without further ado, we'll pop over to the next chart and we'll see what that means. And that, of course, means house price growth. Now, to put this in context, the Chinese authorities have been quite strong on talking down another round of stimulus, just as they did as the one before. I guess they recognise that they've got a debt problem and they don't like to advertise it. And there is some evidence that this stimulus is being better targeted than previous rounds into services rather than more building. Nonetheless, the Chinese economy will have its way, and if you really juice credit in China through whatever mechanisms they choose, like they haven't cut interest rates at this point, but they've managed down their repo rates, and they've given the banks the go ahead to just lend to whoever wants the money. Almost inevitably it ends up in Chinese property, or some large portion of it does, no matter what authorities want. So Chinese house prices already probably responding. As you can see from this chart, we've had various cycles, and the recent cycle never even really had a decent pullback. Through macro-prudential tightening, they managed to contain a few top-tier cities, but lower cities really ripped, and it looks like, before we've even managed to hit the brakes, we might be off to the races again. So if you pop over to the next chart, we've got this one is all China real estate starts versus sales, and the blue line was sales, and because the deleveraging was starting to hit real estate at the end of last year, in the bottom right of that chart, it started to look like we would see starts come off. So
sales were sort of at multi-year lows.
They were coming off pretty hard, and land sales look the same, which are the two best leading indicators for construction.
But for anyone listening in, it's done quite a sharp bounce at the bottom of that.
It has, although land sales haven't yet. So there's still obviously some cause for concern about the trajectory for building, but I think with the credit surge, it's likely to rebound. And the orange line you can see there has been pulling back. That's starts, floor area starts, but they're still up 6% year on year today. And it looks like that those two lines are converging more by sales rebounding than starts coming off. And so if we just pop through to the next chart, this is a chart that just amazes me every time I look at it. It's total floor area under construction in China. And as you can see, you go back 5 years into sort of 2014, 15, when there was the first kind of attempt to deleverage with Xi Jinping, and we had a couple of flat years where starts fell away enough that the total floor area stopped growing, and that's what devastated global economies. Global commodities, as supply was coming on, and China's floor area under construction flattened out. It was a disaster, and so you look at what's happened since. Like it's just more debt and more building, and they're building some staggering amount of things. These are like multiple large cities per annum that are under construction, and at some point it'll become impossible to keep growing this chart. But at this stage, after 3 months, we're up 8% this year if you annualise the first 3 months. I don't expect the year to end up 8%, but with all that credit flowing, a few months ago I was expecting this chart to pull back to no growth, and at this stage now it looks like it'll be another year of more floor area under construction in China.
And so to put that a bit in perspective as well, there's actually fewer people. So there's the argument, obviously, that there's a lot of people moving to cities in China, and so they need to, they need to shift people in. But that's no longer as much of a story as it was, and they've actually passed the point of growing numbers. So there's actually fewer people moving to cities now than what we saw 3 or 4 years ago. Mm-hmm. So so what we're seeing is more building for fewer people that are actually moving. So what that means is there's actually a lot more knockdowns.
Yep.
And so basically you're ending up in this part where you have to knock buildings down in order to build buildings for new people. To build new buildings, because you've otherwise there's literally nowhere left to build because you too many empty apartments. And so the question for the bigger, longer term question is, how long can China keep knocking down some serviceable buildings just to stick up other ones that to keep the economy ticking over? And you'd argue, well, it's not a long-term sustainable solution, but it is a short-term sustainable solution, and potentially even a medium-term. And we've likened it to a bit to the Soviet Union spending on military, towards the end of its Cold War with the US, where it was sort of ramping up, and the whole economy was all based around this military spending. And China's quite similar in our view, in that the whole economy is based around this whole building. We've got to keep building, even if it means knock stuff down to stick up new stuff, because it's where the economy is based, and it's where the vested interests make their money, and so they're certainly interested in this thing ticking on, and the Chinese authorities are finding that if they let it slow too much, then unemployment starts to rise, and people get upset, and maybe that whole debt will come crashing in on itself, and so just got to keep building.
So on that point, that sort of seems to me almost like GDP busy work. So the question, I guess, is obviously knocking down buildings and rebuilding them, fantastic for local labour and these sort of things. How does that sort of play into perhaps resources and Australian commodities and that?
Well, let's come back to that. But I mean, the basic notion that Damien's pointing to is it's misallocated capital, and the more you put in that's debt funded, the less productivity you get, the less return you get on that investment, the more choked up your economy gets in terms of income growth, in terms of advancing lower classes, in terms of prosperity, in terms of everything. And so,
if you weren't increasing debt to do it, you'd have an argument that maybe it is productive. But the fact you've got to keep your debt pile keep getting bigger and bigger and bigger, and it's sort of that part about
for slightly newer buildings.
Exactly. Yeah.
So I mean, the more you kick this can, the worse it gets down the road. That's straightforward, but we'll come back to that.
Okay.
So the next kind of link in the chain that I wanted to point out. So we now have this sort of China's juicing debt, inevitably more building, and then if you swing into the next chart, this may seem a little odd. This is a chart of German investment versus Chinese, which just shows you that Europe has become a complete second derivative on China. And I'm not pointing this out randomly. This is important if we think about the implications for Forex that's coming out of China juicing growth. And that is, it's going to lift Europe. Now, at the moment, or the last couple of years, we've seen a very strong US dollar because we've had China deleveraging, and that dragging Europe down, which has led to a very weak euro, as the European economy undershot everybody's forecasts, especially the ECB.
Yeah, and it's probably worth saying as well that we think there's some structural issues with Europe that even ex-China, the Chinese, the weakness in Europe wasn't just because of China. The China was already structurally weak, and then the China's just China's weakness sort of one extra
drags it down. That's right.
I've got a question just before we move into the Europe story.
Sure.
So we've got how have the Chinese been able to reduce capital outflows so effectively this time around, and have they been able to so successfully regulate sentiment despite weakening consumer confidence?
Well, confidence measures, you get all sorts of mixed ones out of China. Some of them are indicating confidence is up through all of this, others down. I guess you would take retail sales as the ultimate barometer of that, and they have been sliding. So I would say that sentiment has diminished in China, but it hasn't fallen off a cliff.
Mm-hmm.
And in terms of capital outflow, well, I mean, it's pretty simple. They've just shut their capital account. I mean, they've slammed the various corporations that were running around the world buying assets, caused them to repatriate everything, sell assets, all sorts of stuff, arrested a few of the executives, and they've been sent off for organ harvesting. And so that's put paid to the big money.
Sorry, just to clarify, David's being facetious with the organ harvesting.
Yeah,
They've been sent off for re-education might be a better better way to put it.
Yeah, re-education, and then more at the granular level with the little guys. There's been innumerate sort of new rules and new scrutiny of the money that was coming out and largely going into global real estate. And so, that trade has been largely curtailed through banks, through money transfers, through all sorts of different mechanisms.
Okay.
And that's held the yuan quite steady. They've done a good job. The other thing to remember is that Chinese capital flight happens when the economy is weak. Oddly enough, it's the reverse of what you'd expect. Not strong in terms of, we're seeing all this Chinese stimulus and now credit flowing, and typically that would devalue a currency, but in fact the yuan's going up. And that's the way it tends to work in China, where you get stronger growth, you get capital inflows. At the moment they're really chasing stocks, but bonds as well. And so capital pressures are actually, or flow pressures are easing at the moment as Chinese growth looks like it will pick up with more credit. But the fundamental story is capital controls.
Okay, all right, yeah, no problems. Thanks for that, James.
So onward and back to Europe, and the point of this is really about the Australian dollar. That is that if Chinese growth rebounds and pulls Europe up, this will be coming right alongside a slowdown in the US owing to its diminishing corporate tax cut and the fiscal cliff that comes at the end of that. And so you'll have a reversal of the US growth leadership that has kept the US dollar so strong for several years.
And not even necessarily a reversal. I mean, there's certainly scenarios we can see where the US slows, but not that much. But it's more that Europe's been seen very much as the weak link in the chain, and that if it's no longer as weak as what it was, there's currency is a relative game. It doesn't need to be. You don't need European growth to be higher than the US growth to see the euro rise. You just need Europe not to be as weak as expected, there's certainly there's a lot of people betting against Europe at the moment.
The market's very short the euro, as it is the Aussie dollar, and Damien's quite right pulling me up on the word reversal. That's too strong. We don't see this as like a 2016 repeat. It's analogous, but it's not a repeat. It's not as strong.
It's an echo.
An echo is a better word. So, therefore, we see a kind of probability that the euro will rise, the US dollar fall, and that obviously puts upward pressure on the Australian dollar. And so that's how this sort of supply chain, if you like, could affect Forex coming out of Chinese stimulus. And that's not to say that the RBA is no longer going to cut. I still think it's going to cut, and that's going to be downwards pressure, etc., etc. It's just that you're going to have a global reflation pulse out of China that will put upward pressure on the dollar. So we don't see it running away at all, but we have bought some of our US dollars back to Australia because it could run to 75, maybe. Maybe the RBA moves quickly enough to prevent that, but there is going to be upward pressure from a Chinese-based reflation, is the point.
Okay.
On the Australian dollar.
Okay. All right. Fantastic.
Okay. So swinging through to sort of segueing into more Australia impacts. Iron ore is a really interesting one at this point because the price has flown so high on the Vale problems. this was a real tragedy for the Bears as well as for 300 poor Brazilians. I think iron ore probably would have been at $50 in the first 3 months of this year if it wasn't for the Vale accident. There were there was creeping weakness coming into Chinese demand, and if the supply situation had been fine, I think it would have been quite difficult, and the housing bust in Australia would have been facing a real kind of amplification problem in external weakness. Well, we had the Vale shock, and as horrific as it was for the Brazilians, it was actually great for the Australian economy. So iron ore's all popped up almost to $100. We've now had what appears to be probably the worst of that crisis past. Just in the last few days, we've had the Brucutu mine going to reopen for Vale. That's 30 million tonnes. That pulls the impact from Vale down to about 50 or 60 million tonnes, and you can see 20 or 30 of that easily being offset, and so you end up with a pullback in the iron ore supply of kind of 20-30 million tonnes over the year, and that's not disastrous, that's manageable. So iron ore will on that supply story would diminish in price as the year goes on, and as Vale corrects things. That's probably going to be slower now simply because Chinese demand will be better than I expected earlier with this new building pulse. So 85 first half, diminishing towards 80, 75 in the second half, but they're all still very high prices from miles above the budget, still feeding in heaps of dough into Australian fiscal policy if needed. Coke and coal is probably roughly the same story, but thermal coal is a really interesting one.
Actually, just to put it into context as well, the whole commodities. Basically, if you're expecting China to grow a lot stronger, then you'd usually expect commodity prices to be higher. And so, and these are three, and which we'd go along with that, and we certainly agree at the moment. Why we've pointed out these three is because these three are three that actually have special circumstances where we think the effect's going to be a lot less than what we're. That was for Australia, certainly. It could be a lot less than what you expect.
Yeah, this will actually be the opposite this time on these three. We haven't got base metals up there, but we think that'll probably follow the traditional pattern, which will track building up, and we're actually looking at base metal producers at the moment. But these three are in unique circumstances, as Damo says, so that they're actually going to unwind as China comes up, but I think the unwind will be slower. So coal has become a political football, as Australia has sided with the US to some extent in this Cold War 2.0 scenario, banning Huawei and various other pushbacks on the in quotation marks silent invasion of the Australian Parliament, bribery scandals and what have you. And so, we've got a new government coming in. Maybe they'll try and do a deal. I think that'd be ill-advised, but they probably will. Nonetheless, Australian coal is big time on the nose, and this is going to run for most of the year, even if they get a deal up. And so thermal coal's crashed from I think it was up around 120. It's as high as 120. It's back down to 75 and still falling. So that's a bit of an offset for iron ore and coking coal.
And from an investment perspective as well, it's pretty hard to. You've got an asset, as you said, that's down 30-40% on the basis of some political issues, which might be resolved, might not be resolved. Like it's a bit of a binary outcome in terms of you could make an investment in that, and all of a sudden, US China get a trade deal away, and they decide that coal's going to be they'll start taking Australian coal again, and everything goes fine. Or you can see the current situation keep escalating or keep getting sort of sliding away. So that's a bit of a binary outcome, and so we're sort of just avoiding that as a question. But at the moment, it looks like a negative rather than a positive.
Okay.
Yeah, and coal and gas kind of locked at the hip often in their price movements, at least in terms of the pure gas pricing in Asia. obviously both of them being energy plays. So the LNG prices crashed in Asia as well, although obviously a lot of contracts are oil linked, so that protects gas to some extent, although less and less over time, because the customers want to shift away from that. But gas prices have been absolutely slammed across Asia, and partly that was a warm winter, but it's also the coal crash.
And the other part for that is potentially for Australian gas, the worry you have there is that the US get as part of the deal, that the trade deal that's happening between US and China is that you get more US gas and less Australian gas effectively.
Okay.
And there's also a potential upside, a big potential upside for domestically for Australia in this last story, in the gas story. We do have this Australian domestic gas security mechanism, which is supposed to be domestic reservation. Alas, owing to a weak-kneed coalition government and the election, I think, and probably the resources minister looking for a sinecure in the gas sector after he loses his job, they haven't implemented the reservation policy at all, and gas prices are based on that policy. It's supposed to be at $5 or $6, and it's still at 10 or 11. Nobody talks about it in the press. I don't know why, but that's the reality of it. Both the government and the gas cartel have effectively walked away from that agreement. But I think when Labor comes in, if they've got any brains at all, they'll enforce it much more firmly, and you will see big utility price falls in Australia.
Right.
For gas and electricity, because gas determines the electricity price in the national electricity market, being the marginal cost producer. So that could inject $15, even $20 billion worth of stimulus into the eastern economy if Labor gets that right. There's actually...
And David and I have active discussions about this. I completely agree with David that that's the logical thing to do. I'm just not sure that that's what's going to happen.
Yeah, I mean, Labor have been keeping their heads down about it, which is quite sensible. That's what I'd do, given their history of warfare with resources and resources being kingmakers in elections and what have you. And I mean, there's a terrible irony in this with Bill Shorten having been the one that, effectively executed Kevin Rudd over his mining war and tax and what have you, is now sort of confronting, not the same questions, but a similar kind of battle. But I guess my point is, keeping their heads down does not mean they're not going to do it, because that would just be sensible politics. And the other reason is, this policy is already there. It's put there by the coalition. So it's bipartisan. All they've got to do is implement it. They don't even have to create any new policy. They don't need a fight. They've just got to say to the ACCC, implement the policy. And gas prices will crater. Now, longer term, they need to change it to ensure they stay low. But anyway, bottom line is, these three unique commodities are not going to follow a typical China pattern.
Okay, yeah, sure. So, and that's obviously the commodities wrap. I've just got not so much a question, perhaps a comment, perhaps before we roll into the consumer side of the effects on Australia, which is, so China saves the day again, and Australia gets to fight another day. Is that a summation?
No, I wouldn't put it that way. I would say, the Australian economy is slowing fast, owing to the housing crash. Basically, this China boost will help. Yes, at the margin, there's going to be lots of fiscal options for Labor to spend some of this money. Nonetheless, the headwinds in housing are very real. They're prudential rather than being the price of credit. I think the other price...
What David means by prudential is we were lending people far more than what they could afford, and now, following the Hayne Royal Commission, that's been pulled back, and so it's literally a matter of somebody who used to be able to borrow $1 million now can only borrow 800,000. So it's not something you can come around and go, well, if I cut interest rates by 50 basis points or 100 basis points, doesn't make still means you can't afford that
The
loan.
total amount,
the total
remains the same.
And especially as most of these loans are they need to benchmark them against a higher interest rate in case interest rates go higher at some stage. So
Yeah, I mean the analogy, the best analogy to draw here to understand the differences would be to say 2010, coming out of the GFC when we were, as it were, saved by China. Falling house prices suddenly turned around and turned into a boom, in part because we're flooded with Chinese income. That is not what's going to happen again. They're basically the only people who are going to benefit from this is foreign shareholders of mining companies who get all the income windfall, largely, and the Australian government. What saved the Australian economy in 2010 was that we were still in the phase of the mining boom where there was a supply crunch. And
Labour supply crunch.
Sorry, a commodity supply crunch. And so the high prices led to investment and massive job booms.
It takes far more people to build a mine than what it does to operate one.
This boom is completely different. The miners are cutting jobs. They still have excess capacity. Now, this is despite the Vale stuff, which has changed the equation a little bit short term, but that isn't going to change anything long. There's a little bit of extra investment out of Fortescue, but the big investment's done. The big investment in gas is done. Like, there's no new jobs boom coming out of this, and therefore the income flows into people's pay packets is just not there. It won't be there.
And I think what we're trying to come from, while we've listed these three commodities, these are Australia's three biggest exports. And so you will get an upward lift from other commodity prices rising, but of your three biggest ones, iron ore's already had most of the price rise, and so now it's a question about the speed up in China versus Brazil coming back online and what that does. And so I guess we're sort of locked into that. Look, it might be a little bit higher, a little bit lower, but you've already had most of the price rise. Coal, we've got this huge political uncertainty, and we're seeing price falls. And gas, which is we're about to be the largest exporter of gas in the world, and the way we structured the royalties means that actually not that much the royalties actually flows to government pockets yet. Now we've got to wait sort of 15, 20 years for them to get over all their capex spend before we finally really make some money out of that. So what you would have expected to be quite a big push into the budget, and let you have all these tax cuts, won't be anywhere near as big as what you might have expected. And we think the Chinese growth push is probably not going to be as big as prior ones anyway. And so so the scope for those tax cuts, which is sort of our first part on the consumers, it's there, but it's not as large as what you might have seen elsewhere. And the question will come about how big will they be? Will you see
look, the second and third tranches are never even going to see the light of day. We're going to get some upfront stuff, but I suspect by the time you get to 22 and 24, when the rest of these tax cuts flow through, the budget will be toast. They won't ever make it. I mean, Labor's already canned half of them anyway.
But effectively, anyway, they make believe stuff.
They are make
believe. In the end, what matters for the Australian economy at the moment is what are your tax cuts today. And in the next 2 or 3 years, not what do you think they're going to be in 10 years' time, hoping you're still in power.
And they're relatively minor. Very minor relative to previous booms. So in terms of is China save the day again? Look, it's going to make the ongoing correction a little easier. That's it. But it's an ongoing correction. The income recession will go on. I think there's not going to be enough fiscal to turn the economy, so the RBA still cuts. So 2020 shapes up as a year where you get some stabilisation. House prices maybe stabilise a bit. A little bit of heat comes off the consumer. Labor tries and fails to get wage rises because the labour market's still soggy. But there's probably enough firepower federally to prevent this turning into the feedback loop of doom, right? Where your banks start to buckle, you've got to bail them out, you lose your budget, etc., etc. China's helping in that respect, but it's definitely not the same. It's much weaker than previous bailouts, if you like, that Australia has enjoyed.
And it's worth noting that that echo analogy is probably the right one in terms of saying that the first noise was the post GFC, or during the financial crisis where China came out and spent a bucket load of money and pushed all this, and then we sort of saw a few echoes of that, but each one's getting gradually lower. And as you saw in that David's debt chart, each one's sort of less and less as
each one gets soggier, and this is where you get to a sort of longer term outlook. Like each one of these kicks at the can makes the Chinese circumstances worse. Sure, it's okay
in the long term.
Long term,
short term good.
Each one's good for 18 months, but you go out to 21, 22, and you have China looking more and more like Japan. Productivity falling, just all this unproductive debt everywhere.
Move on to. Let's just cover up quickly on the currency, and we'll jump to that.
Oh yeah, sure. Okay, so.
And the capital controls.
Consumers, minor tax cuts not enough. RBA to still cut. Capital controls are not going to come off in China because they're going to have to keep easing. If anything, I see them getting tighter. They haven't even cut rates yet. They may have to do that before their stimulus is done.
And why we're saying that's important for Australian housing is sort of our two parts. There's lots of little drivers for the Australian housing, and negative gearing is one of them. But the two biggest ones we think is the availability of credit, which we can't see anything turning around on that. And the second part is overseas borrowers, and that's where we're seeing the Chinese capital controls that have come in have really put a lid on that. Plus the sentiment issue of a housing market that's just fallen 10-15% is no longer as attractive as one that's just risen 10-15% for an overseas investor who's not au fait with all the intricacies of the local economy.
And
so
what about the apartment buildings with cracks in them? Do you reckon that's helping the international apartment story?
They probably don't hear it. They probably don't even hear about that, Tim. That's
there's going to be less building. There'll be less Chinese capital flowing in and less building. All of that.
So we're not seeing a turnaround in those two big parts.
No,
the capital controls
not at all. I just see a short-term potential rise in the Australian dollar versus the US for the reasons already discussed, like Europe improving, US just plodding through a slightly more difficult period, and probably the AUD falling against the euro for a while. So, we're looking at Europe as well as a short-term play.
Just on that actually, and Beach Life has offered a question earlier, and hopefully he's not at the beach by now, but bearing in mind the likely direction of rates and unemployment in Australia, how do you see, and I think you just answered the short to medium and long-term impact in the AUD?
Oh, it's still down, definitely.
In the long term.
In the long term, absolutely.
Yeah.
All of these Chinese pulses in a way are negative for Australia, right? Because at the end of the day, for the various reasons we've discussed, none of them really offer any long-term boost to the Australian economy structurally. Cyclically, they give you a little pulse and helps you get through, but structurally they just delay the adjustment that you need to go through, which is still to get your real exchange rate lower so that we can just start competing again in anything other than dirt. And until we get the dollar down to 55 cents or 50 cents, we're just not going to get that. And so inexorably that's where it's going to head, and China's just delaying it.
Yeah, sure.
Each time. So,
while we're on the topic of longer term outlooks, we might as well roll into this slide. Where would like to begin?
Yeah, okay, so 2016 debt boom, and it is only, we've discussed this, and it's an echo. It's a soggy echo. It's not the same thing for many different reasons. It will help a little bit at the margin, but that's it. Then you looking, Chinese growth still debt funded, long term unsustainable. This makes it worse, absolutely. It's important to see these two things as cyclical and structural in China. We're going to see a cyclical bounce. It makes its structural potential growth lower each time it does it. Capital Economics, for instance, is already forecasting, I think, 2% growth in China by 2021. They're very good on this. They understand the dynamics very well. 2 or 3%. And you could argue, guys like Michael Pettis and Damo here, if you're actually calculating Chinese GDP correctly with the right amount of write-downs from all the dud debt, you'd probably already be at 4%. And so it's not hard to get to 2. And so Australia, still weak, less affected by this stimulus than other times. It's just that this is going to provide some backstop for the unwinding domestic demand that we've been confronted with over the last 6 months.
All right, very good. Thanks for that. And now we'll roll into investment implications.
Yeah,
Damo.
so the main thing to note on this one is it's a pause in the overall view. It's not quite a reversal, and I guess the title's quite right in terms of changing tack. We've still got the same location in mind, but when you're sailing and you're going into the wind, you can't sort of head straight where you target. You need to sort of tack back and forth, and we think that's sort of where you're positioned at the moment. Quite fortunate in a way, but we've seen our view on bonds has sort of been vindicated. We still think there's further run on the bonds, and we sort of spent a long time arguing about that over the last few weeks before coming to the conclusion, look, we still think those arguments stand in the longer term, but in the short term, we don't think that's they're as likely to head in that direction. So we've pulled back our bond overweights quite substantially.
Okay.
We've reduced, as David said, our US dollar currency exposure a fair bit, and busy looking for opportunities in Europe. So we're sort of still going through the portfolios and reweighting. But I think the main thing to note is that, look, we still think that long-term investment view that's held for the last 7 or 8 years at least is still in place. Is that structurally speaking, Australia needs to get through this period and make these changes.
So we're still much longer international equities, and we're still quite long bonds. So.
Yes, yeah, and we went to, and we're at minimum weights in terms of Aussie equities. We sort of went through the Aussie portfolios trying to find new things to buy, and it's still very hard. Australia is still expensive versus the rest of the world, so you're still facing low growth, expensive stocks, and very much most stocks are either have some effect from the housing market, which we still have quite a negative view on. So there's not a reason to step back into Australian stocks, but it is a reason to reduce some of that overweight. Take the profits on the bond trade. Ideally, it would have been 3 or 4 weeks earlier, but yeah. So we've taken there would have been more profits, but we think those profits will come back.
Yep.
We just think in the short term and short and medium term, until we get through this growth pulse and get more of an idea about how big it's going to be, it's we don't need to be dogmatic about the overall view and sort of we don't need to we can fight that battle later.
Yep.
It'll be on pause again, and there'll be another chance to go overweight bonds and to go back into the US dollar, a bit more strongly into the US dollar at a later stage.
Just a quick question there before we roll into Europe. So just another question from James. So we've got Chris Joy, who, if you're listening, we'd love to have him on the podcast, has always been quite measured in his economic analysis. He believes that there is a 100 basis point cut, which would cause a 30% boost in house prices. I'll parlay it into the next question from Beach Life. And so do you see the AED possibly going to 75 once this pulse settles, say by year end or 12 months? Where do you see the AUD? So they're somewhat intertwined.
Okay, so I think there's an ice block's chance in hell of Australian housing rising 30% from here.
Looking forward to a great interview with Chris.
Over the long term.
Sure.
But in the next, call it 18 to 36 months.
Yeah. I think 100 basis points of cuts, which I think are coming over the course of from here through 2020, equals 50 basis points of mortgage rate cuts.
Yep.
Which really takes us down to where we've already been, and the prudential headwinds again. That's the distribution of credit, like who gets to borrow. Credit lending standards, rather than the price, are still very high. There's no real risk of them falling, and then you've got negative gearing going. I mean, it's a big call to say that even 4 rate cuts is going to make much difference. I think it'll be enough just to put a bit of stabilisation in and not much else. What that actually looks like, whether that's sort of dribbling falls or mild rises for a little while, I'm not so sure, not too sure. But for me, that's only say over the next 36 months, say. But then once China stagnates again and the terms of trade shock resumes and returns, then the income shock gets worse and worse and worse going out 5 years sort of time frame, and house prices just keep falling as far as I can see. Some of those falls may be in real rather than nominal terms, but
So what David means by that is that it's quite likely we see a scenario where house prices sort of hit a bottom or close to a bottom and then hang around there for years and years and years.
So it's flat line against inflation, effectively.
Exactly. So you're underperforming inflation, and so you don't fall. You might not fall in actual dollar terms, but in versus inflation, you have fallen.
And that's what happened in Sydney after 2003. It corrected nearly 10 or 15% just in real terms. So I don't see any big rebound coming in Australian house prices. I don't see any flow of capital coming from offshore, and I can't see household debt resuming any meaningful climb. So where does it come from? I don't know. The Australian dollar, you just don't know. Of course, currency is very difficult, but yes.
Actually, I might just jump in quickly on that housing one, though, and we can see tail risk scenarios where you do get significant falls. So I think there's an issue about saying, how far could housing fall? Could it fall, 30% in real or in nominal terms and things like that? And you go, absolutely, I can see a number of scenarios that could fall, that could come in play, which you have to worry about. But I'm not. And some of those might be foreign shocks overseas, and the whole I guess once you get a psyche within the investor market that you're going to lose the tax cuts and stuff like that, and you can paint a lot of scenarios to get there. The question is, with all those, you never know what the reaction is going to be of the government of the day. Are they going to just stand aside and let this thing fall over, or are they going to step in and throw things at it? And so you can't really make those. But what we're not looking at is scenarios where we're not game planning for scenarios where house prices are up 30%. So we're sort of seeing the best case is you get this stagnation. And then you can see some tail risks where there is downside to it.
Okay. Yeah. Thanks for that.
And the Aussie dollar, well, as I say, it's still this big struggle that it's been in for a while now, between very high commodity prices in terms of trade, which is traditionally a very strong upward pressure, and that associated with a global risk on and global pulse and Chinese credit, etc., versus the broadening negative yield spreads from Australian interest rates to the world, especially US, and we're still way below the US interest rates here, which causes capital outflow and obviously diminishes the impetus to buy the Australian dollar. So those two things are still at war. The negative yield spreads have had their way for the last 12 months, enough that the Aussie's fallen quite a bit, say over 18 months at least. But I just think with this Chinese credit pulse for a little while, it'll be the commodity prices, or rather the sentiment around Chinese growth, that might have enough impetus to have the say for a while. And 75 is just picking a number out of the ether. I mean, maybe gets that high. The point I guess I would make is, because this is a soggy echo, it ain't going back to 80, but it might go a bit higher. Is the point.
Yep.
Pick a number.
Yeah, and given our longer term view is lower, we're not sort of taking active currency bets in the other direction.
Yep.
Sort of figure that's who knows whether you can time it just right or other things happen, but the general trend is down. We just think that you're in for a pause for the next little while.
Okay. All right. Fantastic. And just finally, Europe opportunities. If we can just cover off on those as a new focus. I think we haven't spoken about Europe for a while.
So we're digging through the stocks there, and it's a matter of finding the right. We have been overweight Europe, technically speaking, for some time now. Not because we've actually got stocks. Because we've got stocks that are listed in Europe, as opposed to stocks that actually have exposure to the European economy.
Okay, so now we're looking more at European economy.
And now we're sort of digging through some of the opportunities we can see within that, and some of the exporters where we think they might, some of the companies that we think are have the leverage to the Chinese economy and might pick up a little bit in terms of same way as you look through the commodity stocks in Australia when you know China's going to be is pushing out the debt, is the same thing. We're looking through some of the European stocks where same thing could happen.
Okay, all right, fantastic. Thanks, gents, and we'll roll into not next week but the week after. We've got another special guest in Matt Barry, who is the CEO of the world's largest crowdsourcing marketplace, Freelancer. Really looking forward to that. We're going to be speaking to him just earlier on, and we won't be live with that one. That'll be pre-recorded, but that's coming out Thursday on the 2nd of May at 12:30 p.m. So stay tuned for that one. He's known particularly recently for some quite strong viewpoints on the state of the Australian economy and in particular the housing market. So it'd be interesting to see his thoughts there and whether there's much correlation. I suspect there might be. So tune in for that one. That'll be fantastic. Well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return, we'll send you a weekly email with new webinar topics, links for our podcasts, and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you with the next one. Cheers.